You probably didn't notice the exact moment it happened. Maybe it was a Tuesday. Or a Thursday after work. You were sitting in a chair that wasn't quite comfortable, in a room that smelled faintly of new carpet and printed paper, and someone across the desk slid a page toward you. There were numbers on it. A lot of them. But really, they kept pointing to just one, the monthly payment. And it seemed reasonable. It seemed like something you could handle. It fit inside the month. It didn't feel like a crisis. It felt like a decision. So you signed. And then you drove home in a car that was already worth less than what you owed on it. Most people don't realize that's not a bad luck story. That's not a one-off mistake. That's the standard outcome of a system that was designed to feel like a good deal while quietly doing something else entirely. This isn't random. Let me show you what's actually happening underneath the surface of a car loan. Not the dramatic version, just the quiet mechanical one. When you finance a car, you're not just borrowing money. You're entering two simultaneous processes that move in opposite directions, and they never told you that in the dealership. The first process is depreciation. A new car loses roughly 20% of its value in the first year alone. Another 15% the year after. By the time you're 3 years into ownership, you're driving something worth potentially half of what you paid. That's not a flaw in the car. That's just what vehicles do. They're machines. They age. The second process is your loan amortization. In the early months of any installment loan, the majority of what you pay goes toward interest, not principal. Not equity. Not ownership. On a typical 72-month auto loan, you might be paying only 10 to 12% of your balance down per year in the first few years, while the interest quietly takes the rest. So here's what that creates: a gap. A space between what you owe and what the car is worth. And in the early years of most auto loans, especially long ones, that gap doesn't close. It widens. The dealership knows this math. The bank knows this math. You were never really shown this math. That gap has a name in the industry. They call it being underwater. And in the United States right now, nearly 1 in 4 trade-ins involves a buyer who is still carrying negative equity from their last car. Meaning they owed more than the car was worth when they tried to move on. That's not a rare situation. That's a pattern. And patterns are worth understanding. Here's where it gets quieter, and somehow more unsettling. Because the gap itself isn't the only problem. The problem is what people do when they feel the weight of that gap. When someone realizes they're underwater, or when the car gets older and needs repairs and no longer feels worth having, the most natural thing in the world is to want out. So they go back to a dealership. They trade in the car. The dealer offers them something for it, maybe less than they hoped, and the difference, that negative equity, doesn't disappear. It gets rolled into the next loan. So now the new car loan is not just financing the new car. It's financing the unpaid debt from the last car too. And the cycle starts again. A little heavier this time. A little longer. A slightly higher monthly payment that somehow still feels manageable because they stretch the term out a bit. This is how people end up with 7-year car loans. Not because they made irrational decisions, but because each step felt like the only logical next move. Sell, trade, roll, restart. Month after month. Car after car. The cumulative effect of this pattern on a household isn't dramatic. It doesn't announce itself. What it looks like, from the inside, is a low-grade financial tightness. A feeling that money is always slightly short. A sense that you're working hard but not getting ahead. That savings feels slow and fragile. That an unexpected expense, a medical bill, a home repair, creates a level of anxiety that feels disproportionate to the number. But the number matters. If your car payment, plus insurance, plus fuel, plus maintenance accounts for 25 or 30% of your take-home income, there's simply not much left. Not for building anything. Not for absorbing anything. And most people in that position don't know exactly why they feel financially thin. They just do. The car sits in the driveway. It does its job. And it quietly takes a third of every paycheck before anything else gets a chance. That's not a crisis. It's just a slow drain that nobody labeled for you. Now, I want to be careful here. Because it would be easy to turn this into a story about villains. About dealers who manipulate and banks who exploit. And while some of that behavior is real, the more important truth is simpler. This is just how the system was designed to function. Not against you specifically. Just, efficiently. For itself. The dealership makes more money on financing than it does on the sale of the car. In many cases, significantly more. The finance office at the back of the building, the room you get to after you've already fallen in love with the vehicle, that's where the real transaction happens. Extended warranties, insurance add-ons, loan origination fees, interest rate markups. All of it folded into that one monthly number that your brain is already focused on. And your brain is focused on the monthly payment for a reason that isn't stupidity. It's just how humans naturally process cost. We are wired to respond to immediate, concrete numbers. $600 a month is something we can picture. $47,000 over 6 years, with interest, is abstract. We can hear the words, but we don't feel the weight of it the same way. The system knows this. It wasn't designed to fool you. It was designed to make it easy to say yes. And easy to say yes again next time. The 84-month loan, 7 years, barely existed in the mainstream auto market 15 years ago. Today it's one of the most common loan structures. Not because cars got better. Because the numbers needed to fit inside the month. And when you extend the term, the monthly payment drops, and the yes becomes easier to say, and the total cost quietly climbs, and the gap between what you owe and what you own quietly grows. That's not a conspiracy. It's a design. And once you see the design, you can work with it differently. There's a particular kind of relief that comes from understanding a system, not fixing it, just understanding it. Because before you understand it, the discomfort you feel is vague. It's that low background hum of financial anxiety that you can't quite locate. You're not broke. But you don't feel stable. And when the source of that feeling is invisible, the anxiety itself starts to feel permanent. Like something is wrong with you, rather than something is wrong with the math. But once you see the mechanism, the depreciation curve, the amortization schedule, the equity gap, the rolling debt, the discomfort gets specific. And specific is workable. Specific has options. This matters for a reason that goes beyond the money. Financial stress that you can't name tends to spread. It becomes background noise in decisions that have nothing to do with cars. It affects sleep. It affects the way you respond to your family when a bill comes in. It creates a kind of low-level vigilance that exhausts you over time without you ever connecting it to a payment you made in a room with carpet that smelled like new paper. Awareness doesn't fix the loan. But it breaks the cycle of confusion. And confusion is where the most expensive decisions get made. The moment you understand that a long loan term benefits the lender more than it benefits you, that information becomes permanent. You can unknow it. And the next time someone in a finance office suggests stretching payments out to lower the monthly number, something quiet shifts in how you hear that sentence. That shift is worth more than any spreadsheet. So what do you actually do with this? I'm not going to tell you to sell your car. I'm not going to tell you to ride a bicycle or move somewhere with a subway system. Most people need a car. The question is just whether the car you have is costing you more than it needs to. Start by running one number. Add your monthly payment to your monthly insurance to your average monthly fuel and maintenance costs. Write that total down. Then divide it by your monthly take-home income. Whatever that percentage is, that's your real car cost. Not the sticker. Not the payment. The percentage of your working life that goes to the vehicle sitting in your driveway. If that number is above 15%, you're in territory where the car is meaningfully limiting what you can do with your financial life. Not catastrophically. Just quietly. And it's worth knowing that. If you're in the market for a car, the most stabilizing thing you can do before you walk into a dealership is get pre-approved through your own bank or credit union. Not because dealers are dangerous, just because walking in with your own financing means you already know your rate. You've already set your own terms. The conversation changes completely when you're not asking them what you can afford. And if you're already underwater on a loan, which is a genuinely difficult position, the worst thing you can do is ignore it and let the gap grow. Not because you need to panic, but because that gap has a compounding quality to it. The sooner you understand exactly how large it is, the sooner you can start making intentional decisions about what to do next. Sometimes that's overpaying the principal every month. Sometimes it's a slower, structured path out. It depends on your specific numbers. But clarity is always the first step. The April 20th, 10 framework, 20% down, a loan no longer than 4 years, and total vehicle costs under 10% of monthly income, is not a rule so much as a rough boundary. A way of checking whether a decision makes sense before you make it in a room where someone is trained to make it feel urgent. You don't need extreme discipline to use it. You just need to run the numbers before you feel the emotion. Because feeling the emotion first is exactly what the process is designed to produce. I want to leave you somewhere calm. If you're carrying a car payment right now that feels heavier than it should, you're not in a unique situation. You're in an extremely common one. One that was made more likely by how the entire purchase experience is structured: the timing, the pacing, the focus on monthly numbers, the way excitement is strategically built before the financial conversation begins. You made a decision with the information and the emotional state you had at the time. Most people do. And the goal now isn't to feel bad about it. The goal is just to see it clearly. Because the opposite of financial hypothermia isn't financial excitement. It isn't aggressive wealth building or extreme sacrifice or a dramatic turnaround. It's just warmth. Stability. The quiet, unglamorous feeling of knowing where your money goes and making deliberate choices about whether that's where you want it to go. A car is not an investment. It never was. It's a tool, and sometimes a very expensive one. But it doesn't have to be a trap, as long as you understand the shape of the trap before you walk into the room. Take the number from earlier. The one you calculated. The real percentage. Sit with it for a moment. That number is just information. And information, used calmly, is enough to start.